Well, I don't know the real Batman, but I know the Batman of student loans, Travis Hornsby and his awesome team, Connor, are here to help you cry less inside when it comes to paying back your student loans. They've been amazing supporters and sponsors of Dental Nachos for a long time. A story I would like to share with them, because we love to hear stories about patients that like their teeth when we transform their smiles. I do like to maintain dentist HIPAA, so I won't say their names, but a husband and wife team met you guys back in 2019, and they said of all of your sponsors, Student Loan Planner has helped us the most, helped us figure out how to pay back the over $600,000 we've accumulated as a couple. They don't talk about this enough. I always say this is the cry inside monster, guys. For dentists, we have to keep our sweating on the outside, our crying on the inside. And whether it was our first podcast with the Dental Amigos, Travis, back in the day, whether it's the numerous webinars we've done, whether it's you guys supporting our in-person events, I always learn something interesting during your webinars to help me help other people. It's, to me, and you guys can interject if you would like, I believe that dental student debt is more of an emotional problem than a financial problem, more of an emotional stress point than a financial stress point. As someone who talks to dentists of all ages and stages, I talk to dentists who want to sell their practice, Connor, and they say, no way will someone buy my practice because they have their student loans are way too high, and I'm able to correct them, reframe them, and say that's actually not the case. Banks like us more as much as our moms. I mean, if you think about it, you guys deal, Travis and Connor, with people that, what's the highest debt you've seen in one of your consults?
Like 1.8 million is a couple.
1.8 million. Let's do like a double right down the middle of the plate. This year, you're going to get 2024 grads. What's like going to be your most? 400 grand, 500, 300?
800 for 2024.
800,000.
Yeah.
So if your friend had $800,000 in debt and asked for $1 million to buy a practice, you would not likely give it to them. But banks are so positive about dentists that hopefully this webinar does not just scare, it awares dentists, but also shows them how amazing a career it can be and how people believe in their success. So I'm thrilled to sit back and watch. Thank you so much for being an awesome sponsor. We do help dentists find jobs and hire associates through Dentist Job Connect. If anybody watching wants to reach out to us at dentistjobconnect.com, we'd love to help them. But I will turn it over to you guys. Thanks so much for being here.
Thanks, Dr. Paul. Just wanted to share with everybody today. The main goal of today is just to go over a couple things. The first part of the webinar, we're going to talk about how to save money on your student loan interest and using taxes and tax strategies to do that. So there's kind of a really unusual new thing that's going on with dental student debt, with interest savings, with the new SAVE plan, and with the different, tax related strategies that you can use to also save a bunch of money on your student loan interest. So people, I know one of the most common things that dentists tell me is how much they hate student loan interest. And so I thought that would be a wonderful way to show you how, if you could get a 3% refinancing deal right now, you'd be ecstatic about it, or at least a lot of people would be. And, Connor, you can get interest rates in the 0, 1, or 2% range, not necessarily permanently for everyone, but for at least maybe a couple to a few years. And so that's going to be something that I think a lot of people will be really excited about. Just a quick introduction. So I'm Travis. I founded Student Loan Planner in 2016. Connor's been with me near since the beginning. Connor helps oversee our dental group with SLP, but also SLP Wealth, which is a financial planning arm of our sort of umbrella of student loan planner companies. Connor, welcome. It's great to have you as my co-pilot for today.
Thanks.
You want to
glad to be here.
Do you have any interesting dentist war stories before we get started? Any kind of ones that stand out in your head?
Oh man. I've seen some big numbers like we were talking about, but I think ideally what we want to do is just relieve that stress, like Paul was saying. I have a client right now who's going through a full reno of his practice, right? He had like the blue carpet dental practice. That's all getting ripped up, and he's making all these investments, and he was so scared, like I have this student loan, whale that I have to take care of. And we found out that his investments in the practice helped the student loan situation. So lots of cases like that. We want to relieve that stress.
All right. Well, basically the kind of way we're going to do things is just sort of go through a quick presentation, and then we just want to answer people's questions that you've got. So let's just make sure. All right. My screen look good, Connor?
Mm-hmm. That's great.
All right, so we're going to talk about how to lower your student loan interest and taxes at the same time. And for people who hang out with us till the end of the webinar, we've got a giveaway at the end. Going to be choosing 3 people to get $100 gift cards. Woohoo! So, again, also thanks to the Nachos team for having us host this today. So, could you get student loan interest as low as 0%? So, I want to give y'all just sort of 4 groups that could potentially get their student loan interest to 0% with some different strategies we're going to talk about today. So one is dental students still in school. Now, if you're a dental student, if you've got somebody who's currently in dental school, you actually can't get 0, but you can maybe get a low rate. And it's a kind of, this is the most speculative strategy we'll talk about today. The other 3 are a lot more solid. So people in a residency program or dental specialty residency program, that's group number 2 that could get a low interest rate. Recent grads that are 3 years or less out of school could get a really low rate. And then practice owners who are launching a practice or aggressively doing stuff to reduce their AGI, like Connor, your example of the practice reno that the person was doing. Mm-hmm. So here's 4 different examples of these folks that could get really low like interest rates. And maybe I'll take the first 2, and then Connor, if you want to take the second 2 for the recent grads. Yeah. With, using that prior year tax return, and the practice owners who are just starting out or have a lot of, deductions, just to explain how it works. But at a high level, right, the Saving on a Valuable Education Plan, the SAVE plan, it is a good income-based repayment plan. It's not necessarily always the best, right? But one of the things that new plan that President Biden rolled out about a year ago, one of the things it does is subsidize your interest so long as your required payment is lower than your accruing interest. So if your required payment is higher than your accruing interest every month, you don't get any interest subsidies, right? So there's a big misconception that, the SAVE plan gives you interest subsidies on the whole thing for everybody. That's not the case. So you only get a subsidy if you have a required payment, which is calculated based off of your tax return, AGI from the prior year. If that number is lower than your accruing interest, you could get a bunch of interest subsidies, right? So the first one, like I said, the first group of people to get a low interest rate, this is the most speculative one we'll talk about today. So, so this first one is dental students still in school, okay? So if anybody has friends or knows somebody in dental school, if I was a dental student right now, what I would do is differentiate between the fact that there's 2 types of loans you take out in dental school, right? There's Stafford loans, which have a limit up to about $40,000 a year. And then you have Grad Plus, which you borrow for everything that you need that's more than $40,000 a year, right? So you have 2 different types of loans. Now, the Stafford loans, you have to defer them. That's the rule. You can't do anything about that. But the Grad Plus loans, theoretically, there is a way to ask for your servicer to put the Grad Plus loans into the SAVE plan by asking for an in-school deferment waiver. So some servicers have this on their websites. Some of them you call for. What happens though is the school's going to report your in-school status to the servicer, and the servicer is going to continuously put you back into deferment. Why does that matter, right? Well, if you have $0 a month payments in the SAVE plan, then you can get credit for forgiveness, and you can get that 0% interest rate because your payments are 0, probably because you don't have a taxable income in school, right? And so the whole idea behind this strategy is if you're in dental school, then you could potentially get the Grad Plus loans out of deferment every single semester by contacting your servicer, and then maybe get almost 0 interest on those loans while the Stafford loans are stuck in deferment, not getting credit, having that interest normally accrue. So again, that's the most speculative strategy. We think that there's no reason from the law that it shouldn't be able to work, but the SAVE plan just came out. We are still kind of workshopping that strategy with people. There's no downside to trying this though. So that's why we're mentioning it today. Now, the groups that are a lot more likely to get subsidies are the other 3. And so I'll take residents, and then Connor can take the recent grads and the practice owners. So if you have, if you're going to your GPR residency, or you're doing sort of a specialty residency or something like that, I often see people in this status get put into a forbearance or a deferment just because that's kind of what automatically happens. And you want to fight that. So if you're doing a GPR or AGD residency, it's a year or 2 or something, you want to consolidate that loan probably to get it into the SAVE plan. And then you can get interest subsidies based off of your prior year tax return when you were a student, probably reflecting a low income or a $0 income, right? And so remember, if your required IDR payment is $0 a month, then that means your subsidy is literally 100% of your interest because your required payment doesn't cover any of it. So that's the group there with residents about how you could get, interest subsidies and the entire thing pretty much. So now, Connor, if you want to tackle the recent grads and the practice owners.
Yeah, yeah. Recent grads have a ton of opportunity. So I first off, also I want to point out a recent grad. Let's say you have ADA's average for just GP dentistry is 300K in student loans. Let's say you're at 350, right? Right around the average, maybe a little bit above. Your fixed payment coming out of school, what they want to put you on the standard plan is $3,900 a month. That's what they charge you by default if you don't make any changes. If you jump onto an income-driven plan, you could be on the save plan. Let's say, your prior year's tax return shows low or very little income. You could have a $0 payment, right out of school. Kind of like Travis was saying, we can consolidate right away, get rid of your grace period. Let's say you have that for a year though, and you know that clock is running out. Well, if you consolidated and requested your plan in the summer, let's say it's now a year after you've graduated, it's summer of the following year. What you can do is instead of filing your taxes right away, right? You're probably used to filing like right on time, right in March or April. You can delay filing your taxes. And then when you go to recertify, your most recent return is still the one that you used right out of school, right? So you keep that $0 payment for another year. You keep your 100% interest subsidies if you're on the save plan. And you essentially you delay having to make any payments, which allows you to save some more, allows you to put away cash for that practice purchase. So lots of opportunities there. And then if you're a practice owner, let's say, a great example, what we wrote down here is if you're launching, right? Let's say you're working as an associate, you take this time to prepare and you have a little bit of a gap in between working and then launching a practice. You can use that gap and do what's called a recalculation of your payment or a recertification if that works. And you can tell the DOE, honestly, hey, I don't have any income right now, right? I'm between work and I don't know how this practice is going to turn out. We know it's probably going to go well, but you can honestly tell them my income's very low. They'll give you a $0 payment and we're back to 100% interest subsidy, right? That buys you quite a bit of breathing room for starting a practice. There's other things that you can do, as a practice owner ongoing. If you think about it, anything that we can do to increase the value of your practice, by making investments, right? Buying equipment, like my friend, my client who's, tearing out the blue carpet, putting in new chairs, all that kind of investment, does it lower your income, right? Lower the net from the business? Yes, but that lowers your student loan payments as well, which may increase, how much interest we're getting subsidized and increases your practice value in the long run. So definitely valuable.
Cool. So let's see what we got here. So the next thing I want to point out is that the interest isn't everything. So there's a couple key things to know, right? A lot of dentists would be better off on a 20-year forgiveness program instead of a 25-year forgiveness program. The SAVE plan is a 25-year program. So for pay as you earn, which is literally going away for new entrants, like July 1, or new IBR, which is available to anybody who started borrowing for school after 2014, those plans actually might be better plans for you than the SAVE plan. So this SAVE plan that we've been talking about, these interest subsidies, the one thing that I would caution people about is don't sort of get lured in solely by thinking about your interest rate on your student loans. Because, first of all, the interest grows at a simple rate of interest, not compounded on any kind of income-driven plan, even the ones without any subsidies. And minimizing your payments on your loans, especially if you're going for forgiveness, might be a way better thing than worrying about the interest rate. Another thing to point out too is, let's say you even have private loans. Let's say you've refinanced back when rates were really low. You might think, well, I've got 3%. I should never pay that off. And, that depends, because if you also have a mortgage, you might be able to deduct the mortgage on your taxes, but your student loans generally are not ever tax deductible really for people in most dental income brackets, right? So interest is not the only thing. It's also, needs to be part of an overall strategy. And we wanted to just briefly cover the intersection of tax planning and student loans real quick. Maybe I'll handle like the first three again, Connor. And then if you want to handle the last two, with, you know, somebody that needs to set up a 401k plan and somebody that needs to avoid, you know, generating a bunch of gains that might have a bunch of student loans. So let's say you're, you know, the ADA average, 300K of dental student debt, right? So if you know, if you're coming out of school, like we talked about this idea of filing extensions for tax returns, right? So a whole lot of people will be recertifying in June every year because you're essentially going to consolidate your loans right out of school, and then you're going to use your most recent tax return, right? So if you use your most recent tax return that you filed on time in April, you're going to be using that April return from the prior tax year every single year. But if you do the extension, let's say this new dentist couple files an extension every year and files their final return in like July or August instead of filing it in April, then they might get a whole extra year of really low payments and low interest. So that's really valuable. Number two option here, or number two person here, the person living in a community property state. So let's say you've got somebody living in Texas or California, and let's say you have a spouse who earns a low income or no income at all. Well, a lot of people don't know this, but in those types of states, which is mostly centered on like the Southwest and the West Coast, you're supposed to split the income in two, 50-50, which could lower your student loan payment by like half. And that could also influence the subsidies that you get on your interest as well, because it lowers your required payment. So that's pretty enormous, right? That's a very commonly misunderstood strategy that people don't really understand and don't really know how to use. The third example is a contractor working in multiple offices. So, you know, a lot of people, you know, so here's just a quick example, right? A lot of people, when we ask dentists that are not W-2, you know, do you have an S corporation? A lot of people don't have one. So a lot of people are paying unnecessary employment taxes. A lot of people also are not paying attention to things like qualified business income, QBI deduction. So for dentists, you can't actually claim that once your income is above certain levels. But if your income is able to strategically stay below certain levels, then you can write up to 20% of your business profits, even though you're what's called a specified trade or service business, SSTB, right? So there's all kinds of just amazing strategies that you can use to like lower that AGI, lower your student loan payment, increase your subsidies if you're going for, you know, and then, by the way, if you're going for any kind of repayment plan right now, I think the smart move with interest rates being so high and with savings accounts yielding so much, I would say like probably 75 to 80% of dentists right now could probably come up with a way to get a subsidy on the federal programs. And honest to goodness, I wouldn't pay extra. If you can go out and earn 5% on your savings accounts, if you could get a subsidy on your federal student loans, it probably doesn't make any mathematical sense to pay extra. So even if you want to pay off your student loans, it's probably a smart move to put them into sort of a hibernation status right now, because you can make more money doing other things. For people that are going for forgiveness, like very clearly going for forgiveness, where you might be better off on a 20-year forgiveness program, because dentists earn a ton of money in the later stages of their lives when they're, you know, making a lot more, right? So it might be really valuable to have a 20-year plan instead of a 25-year plan and ignore the interest benefits on the 25-year plan. So that's just an example of, those are the first three of how tax planning can lower the payment. But, you know, you can also take advantage of some tax credits for setting up 401k plans, and just also being really cognizant of you know, avoiding capital gains. So Connor, if you want to tackle those other two.
Yeah, I've had a lot of clients run into this specifically, where they bought into a practice and practice has no retirement plan, right? I imagine maybe even like some of the folks on this call might have seen that. You know, the great thing is the US wants you, and the IRS wants you to start a retirement plan through your practice. And so they're giving you tons of ammo, tons of reasons to do it, right? So through Secure 2.0, let's say, you know, you buy into a practice with no plan, no retirement plan, you can start up a 401k plan and have part or all of the cost of setting it up subsidized. There's usually one-time fees. There's usually ongoing fees, and you can have some of those or all of those subsidized as well. And on top of that, you have to make contributions to employee accounts as the practice, right? Generally, a safe harbor is about 3%. So 3% of any, you know, employees pay if they meet full-time criteria. You have to make those contributions, and those can be subsidized too. So you basically get subsidies on all the various costs of this. And why would you want to do this, right? Why is this a big deal? Well, with a 401k, you can put away $23,000 out of your W-2 pay from your practice this year. And that's pre-tax, right? If you don't do the Roth option, pre-tax lowers your AGI, which lowers your student loan payments, right? talking about getting back to the interest benefits or, just a lower payment if you're on pay as you earn. But if you think about it, 23,000 bucks, if we can put that away, divide that by 10, that's your benefit on your student loans, right? Your student loan payments go down by $2,300. So almost 200 bucks a month, the next year. So big, big benefit. The other one, the last one's my favorite. So, for a lot of dentists, you'll save into that 401k plan through the practice, right? Maybe we do investing in a couple other places. Maybe we have an HSA. But a lot of dentists end up with a brokerage account, right? We do a lot of saving in a taxable brokerage account. And the great part about that is flexibility, right? We can tap those funds if we need to at any point. The downside is everything that we do in there is taxable. So you can avoid some of those taxes by doing what's called tax loss harvesting, which is actively seeking out losses in your brokerage account, realizing them, and changing your investment into something similar, but not quite the same. And what that does is turns your brokerage account into like a rental property, right? Where rental properties and tax loss harvesting is one of the few places where your net worth can go up each year, but on your taxes, you show a loss. And since we're showing a loss on taxes, again, brings down our AGI, brings down our student loan payments. So really neat stuff. Anything you want to
cool.
add to that, Travis?
No, I think that's great. And then just before we get to the very end here, we have a lot of like what I would call student loan planner, like family of companies, right? So our core offering today, we're going to give you all the Dental Nachos discount link, but we help folks, dentists, with a lot of different things surrounding like student loan borrower needs, right? So the student loan consult is like the core of what we do. And then we have, a tax team, we've got a financial planning team. Connor's involved with our dental specific, financial planning team. So that's just available if you need that help. I want to give y'all a little insight into the dirty little secret of dental student loans. Your debt is most likely an additional 10% income tax. So if you really think about, the reason why banks will still lend you money if you have $1 million of dental student loans, right, is because, and this took a while for the banks to truly understand, but federal student loan debt has no limit on borrowing. In 2006, the Grad Plus program got introduced and they changed the limits to like a strict cap on the Stafford program, which is $40K a year, to up to the cost of attendance. Well, smart dental schools figured that out, right? And they figured out, oh, wait a second, cost of attendance means anything we say it means. Does that make sense? So like schools like, I'll call out a couple schools like University of Washington, like made some mistakes with their financing, some of the investments that they made, and they had these huge shortfalls. Well, they figured out that they could just double or triple dental school tuition over like 10 years and cover up the, and basically kind of not cover up anything, but just kind of cover the losses that they incurred from some mistakes that they, that administration made back in the day. Other schools, right? Like, NYU Dental, like, has raised tuition a whole lot, right? And the reason why that is not going to hurt you is because of income-driven repayment. So income-driven repayment, you're paying the same percent of your income if you have 800K or if you have 300K. Now, the only time that 300 is different from 800 is if you have probably income greater than your debt. So if you're making more than 300K a year and you have 300K in student loan debt, it probably does make sense to pay it off. But if you're making, 150K or 180K, right? Then there's not really a functional difference between 300K of debt and 800K of debt. That sounds really nuts, right? So I guess just to put a plug in for the Nachos job board, right? If you get, a 300K associate job using their job board, you're making a killing. Yeah, maybe you need to pay off your dental school debt if you went to a state school because your income is greater than your debt, right? But if even if you got one of those amazing high paying jobs, but if you have 800K of loans or 500K of loans, if your loans are greater than your income, it still probably makes sense to treat this like a forgiveness, like 10% of your income strategy, right? So if that's the case, think about what a 10% income tax truly means. If you can lower your AGI, if you can lower your taxable income, then you can avoid paying 10%, right? So that makes like lowering your AGI, avoiding unnecessary gains, avoiding like, unnecessary capital gains distributions, those types of things. It makes that stuff way more valuable to dentists than it is for the typical person, right? So with the new forgiveness programs, with how generous like Biden's made a lot of these income-based programs, it's very difficult to justify paying back dental school loans right now. I'm just being honest, right? Like that's what the rules are right now. Like if you have a different administration, a different set of rules, that might change. Maybe a different set of interest rates, that might change. But kind of our goal is always to look at somebody's dental school debt. And on average, certainly not always, on average, we tend to save around like 100 times our consult fee. So our consult fee after the discount, is, we'll show that in a second. But basically our average dental school consult savings on average, not again, some people we don't find any savings for, but we charge like the same one-time flat fee for everybody, regardless of how much savings we find. It's a few $100, one-time fee. We tend to save something like $50,000 to $80,000 for most of our dental school clients. And I'll show an example of that community property thing. Somebody asked in the chat about, I want to see a community property example of what you mentioned. So I can pull up my Excel sheet when I'm done sharing my screen and show that. And also, Connor, somebody asked, when I mentioned the S Corp thing, somebody was like, oh, I have an LLC. Can I convert to an S Corp? So like, that's another thing that's why we expanded into other services, right? Because the answer to that question is an LLC can be taxed multiple different ways. And one of the options is to have it taxed as an S Corp. So if somebody's got an LLC, they don't actually need to like go convert it to an S Corp. They can just simply elect to have the LLC taxed as an S Corp. So that's just a fun thing to know there. So anyways, the nachos discount. So what is this, right? So because we have a special key resource sponsorship with Dental Nachos, we're a proud sponsor of Dental Nachos. We give $100 off to anybody who specifically books through the Nachos link for a student loan consult. So normally that price on, online, on our website, you'll see it's $595. But with the $100 off Nachos discount, it's only $495. So, what is the worst that can happen? The worst that can happen is you spend $500, we don't find savings for you. That probably happens 10% of the time. Probably about 90% of the time, we tend to find, 5 or even 6 figures in savings just with a lot of the different strategies that we talked about today. You can Google student loan planner reviews if you want to double check us online, and you'll see we've got 3,000 plus 5-star reviews. So, you can look and see like that we are by far the biggest provider of dental student loan advice anywhere in the country. And what you'll get from that consultation with us is you'll know exactly what's going on with your loans, exactly what to do, exactly how to do it at the end of that hour. And so that's essentially what you're getting for the Nachos student loan planner consultation. And then if you want to go deeper with us, you can. If you want to get, help with financial planning, tax help, stuff like that, we can talk about that on the consult or after the consult. There's no pressure on that. Our core service is this consultation. That's what we, advertise on Dental Nachos. And then, we, for people that need it, we have additional services, that are again surrounding like a needs of somebody with dental student loans. And then let me see. I think that might be it.
Can I answer a quick question that we just got in the chat, Travis?
Yeah,
of course. Really good one. Ben
asked,
Ben asked about, I'm about to graduate. How do I get on to save? I don't know that we specifically touched on this, but when you're right about to graduate, you have to, as soon as your loans are marked graduated, Ben, you have to consolidate them to skip your 6-month grace period. So you won't have a grace period on your plus loans, but you will have a portion that are Stafford, and those you're stuck for 6 months, right? And in those 6 months, they accrue interest. So the only way out of that is to consolidate. You can jump on save and you essentially save 6 months of interest. That right there could save you an average interest rate on dental school loans now between Stafford and Plus is probably like 7.5%. So if we have, 300-400K, that's big money for 6 months.
Well, that's a great example, right? So like, let's say you're a brand new grad, 2 weeks after you graduate, you'll be eligible to consolidate. Most people don't. Most people just let it ride for the 6 months. Which is the mandatory grace period after graduation, like you said. And when you do that, effectively you take what could have been a $0 a month payment, and then you add on those payments to the end of your forgiveness schedule. So let's just say you're on that 25-year save plan, right? Let's say you're making $300K at the end of your career. So let's just say those payments are about $2,500 a month, right? So by not consolidating right away, right after graduation, that costs you $2,500 times 6. So what is that, like $15,000? And it costs you that. Now, technically, it costs you that in 25 years, right? But it's still 15 grand that you could have put back in your pockets 25 years from now. And that's just one example. The extension strategy we mentioned, if you don't do that extension strategy, then you're essentially like bringing forward an entire year of sooner income that your IDR payments are based off of. So if you're making 150,000 a year and your payments are $1,000 a month, that's a, you know, $12,000 mistake in year 3, because that could have been a, you know, very low payment instead of a very high payment. So those are just like, those are 2 examples. The other thing I'd mention too is if anybody's booking a consult, I would highly recommend that you try to squeeze it in before April. The reason is the IDR waiver is applicable to some people, and that's going away April 30th. We're very quickly not going to have any available spots probably before April 30th. I will say that I think that it's probably fine if you meet in early May, because essentially what they're saying is you have to have the consolidation, if it needs to happen, needs to be finished before July 1. And on average, it takes 60 days to have a consolidation occur. I mean, I think it's probably fine, Connor, you know, to have that consultation in early May, because if you need to consolidate, you probably would just need to do it very quickly, you know? So I think that there's all kinds of strategies that we could cover today. I just wanted to mention a few of those. I'm going to stop my screen share. I'll share our screen again for that discount code for nachos. And then I'm going to show our Excel sheet and maybe just do a couple community property examples and just whatever other people want to see. So I'm going to stop my share.
We've had a couple asks
Could you
from community.
reinforce? Could you reinforce? Great job, guys. Thanks for all the nice things you said about nachos. Feel free to keep saying them again. My aunt would love you too. I do feel you're doing the work of the Lord G.V. Black, because G.V. Black was a famous dentist. So if you use that joke, Dennis will laugh. I mean, it is just nacho nuts to me how all 6,000 dental students don't just run and get a consult for $495 to make sure they are doing the right thing. I mean, nothing bad happens. You either tell them, hey, you're doing the right thing, and that's well worth $495. Or, hey, we can save you 5 to 6 figures by doing this 1 or 2 things. Could you just reinforce and maybe if someone is doing the AGD or GPR, if you're about to do that with your student loans, could you just reinforce that? Because I'm a big fan of AGD, GPRs. Proud of you guys for doing them. I love you. If you're not doing one, I still will be glad to help you, but I'm a big GPR, AGD fan. So let's say you're going to be doing this starting July 1st, just reinforce that part.
Well, the only thing about that I would say is just, you know, that we see like, you know, those loans kind of go into repayment versus like the ones for the dental specialty programs. Like if you're doing a 3-year ortho residency, the schools code it weirdly where it sends people into a in-school deferment. And so the, you know, the GPR AGD kind of setup, because it's not super common, like not a ton of people around the country go through that experience, right? And so the servicers often just don't know how to handle it. So I've seen a lot of them just put people into a forbearance, for example. And that could be a really bad mistake for your loans, because again, that's a whole year of payments. It could have been 0, that if you code it as a forbearance instead, not only do you not get credit towards forgiveness, but you're also accruing 7% interest in all your loans when it could have been 0. So that's, you know, a pretty massive deal. Like even if you've got 150K of dental school loans because mom and dad helped out with living expenses or something, I mean, that's still, you know, that would be like 10 grand of interest that could have been avoided if during your GPR AGD year, or just if you'd known to sign up for the save plan and also to consolidate and get off of that, you know, mandatory 6-month deferment after graduation. So a lot of what you don't know will hurt you because this stupid system is so complicated.
Love that. I'll let you guys keep going, but
it's all good. So maybe if we could look into, somebody asked for real numbers, right? So somebody that's in California or California or Texas or Arizona or any of those states in the chat, maybe you could just throw out like a hypothetical spouse and dentist couple with their incomes, and feel free to kind of make it up and not make it you specifically. But if you just want to throw out like dentist making 200, spouse making 30, you know, 400 grand of dental school loans, I can do a quick model of that if anybody's interested in that kind of scenario. So we'll just wait. I'll just wait a couple. Here we go. So yeah, okay. Dr. Paul did it. So yeah, so dentist making, yeah, there you go. To 210, 70, and then 567. So let me cue this up here. 567. Dang, 567. What'd you do in dental school? Buy a Porsche? Oh my gosh. Just kidding. I mean, that's just that's like that's a low cost school from some places now.
I know, it's cheap school. Someone do the next person. I'm a fake person. Don't do mine. Sorry.
All right. So yeah, dentist.
I don't violate Zoom HIPAA. Do L's. Just first letter.
There we go. All right. So dentist.
G, my buddy G's here. Jay, yeah. Don't forget about me. I'm just cause problems. I'll put my screen off again. I'll be back later.
Oh, we're all good. We got a couple good ones. Yeah. No, I mean, so I mean, actually, Connor, I remember one time I wrote something and one of the dental school deans actually like got really mad at me because they were like, essentially the dean was like, the kids these days, like, I've seen horror stories where they're driving, brand new cars and stuff like that. And I'm like, bro, your dental school costs 700 grand. Like, I mean, like they could be driving like, like the beater of all beaters, and your school is still like whatever, like 8 Porsche 911s or whatever. Like,
Mhm.
it's like so hypocritical, right? I
Yep.
mean, I don't know. So let me just get to one of these examples. I'm just going to try to pick the first one. So 170, 120, 450 for the income there. So, I mean, the big thing with like the new loan rules is like you can file separately for taxes right now in a lot of situations, and that can save you just like a boatload of money. There's issues where you want to have like one spouse claim the kids on the tax return because of how they're going to do like auto linkage to the IRS, where they're just going to pull it straight from the IRS, and they want to see everything on the tax return like done for them so they don't have to think at all. And let me just make sure I save this off as a test file instead of the
And we are
actual
extremely
one.
familiar with this now. As Travis and I and the rest of our tax team, we've all worked on the
Oh
returns
gosh.
now to do this
Yeah,
split.
I mean, we do offer tax help. I wish we didn't, but we do. I mean, so anyways, so 450K debt, 170 and 120K of spousal income, right? So effectively what we're looking at here is that this is the dentist. I'll type in dentist and then spouse. So if this is the split in a normal state like in New York, right? You would probably still file separately for taxes. Your payments would be something like 1,100 or 1,200 a month. So that's what this monthly payment under the SAVE plan is like, that's how much you're paying per month. That's how much you're paying if you're on a 20-year plan, is about $100 a month more than that, about 1,200. So effectively what happens is, in a normal state, that's all you can do. You've got to take a look at the separate costs. Filing separately costs about $400 more than filing jointly for taxes. And so you just say, well, I could include my spouse's income in my payment of 10% of my income, or I could exclude it. And by filing separately for taxes, I exclude that income. So if I do it that way, remember these payments, 1,100 a month, 1,200 a month if you're doing a 20-year plan. So 11 to $1,200 a month, right? That's the if you're, if you're in a New York kind of a state. Now, if you're filing jointly, now you're paying 2,000 a month, right? So you don't want to do that. This would be an important situation where you'd want to file separately for tax. But you can take it a step further by splitting the income if you live in a California, a Texas, an Arizona, I believe Nevada as well, one of these community property states, which is
Wisconsin.
roughly about a third of the country. And so if you click that community property button and you split the income 50-50, well, now we took those payments from 1,100 a month down to 900 a month, right? So we saved $200 a month on your student loans, basically in perpetuity, so you're saving about $2,400 a year. You also have to split your income 50-50 using a form that the IRS gives to people filing separate in community property states. But you're saving a lot of money, right? And this is an example where somebody's got a sort of a similar income, So if we look at one of the examples here where people don't have a similar income, like, dentist making 240, spouse making 80, you're going to see something way different in that scenario. That's going to be pretty shocking. So let me just cue that up real quick.
While you're punching that in, somebody mentioned a situation where both spouses have loans in a community
Yep.
property state. This is just as valuable, because if you think about it, we're getting rid of income where it doesn't necessarily need to be used for student loans. Yeah, I'll pause.
So here's the same example, but with like a steeper difference in the dentist and spouse's income. So if you've got 240 and then 80, right? Then you can essentially, if you file separate, just straight up, your payment's about 1,700 a month. But if you split the income 50-50 again, so now you go back and now you're at 1,000 a month. So that's an example where you're saving 700 a month on your dental student loans by, properly doing this community property split, where you're splitting the income 50-50, right? And then this is like something, again, it applies to a third of the country, people that are married in those states. So this is not like, this is a strategy, you know what I mean? We're not sort of a one trick pony where it's like, this is all we do. There's a lot of different strategies that you could do depending on your individual situation, right? Like, do you have a really old loan from undergrad? Do you have both spouses having loans, right? So, Connor, another strategy that we've seen people use is like, even if you both have loans, if you run the numbers and you find out that married filing separately might not cost you hardly anything, you can use that and save about $2,000 on your student loans per year, even if you both have loans, just because of the way that they assign deductions for how much you have to pay on your student loans. It might be a little too technical to go into, but basically you can get an extra 20K of protected income before having to pay 10% on that by doing separate, even if you both have loans. So there's all kinds of, I would fairly say it's probably very complicated things that go on with this. So I'm going to look at a couple of the other examples somebody asked for. Arizona spouse, 100K, dentist making, what is this one? So Arizona spouse, 100K, dentist making 200, loans at 200K. I'm just trying to understand what that one means. That Trevor asked that question.
I think the dentist has 200K in loans and the spouse has 100K in loans.
Yeah. In that case, sometimes it makes sense to take one spouse and put them on a repayment strategy and have them take their loans out of the federal system and just say, hey, pay this off. And then the other dentist or the other person that needs to keep it federal, does the filing separate, getting on an income-driven repayment, something like that, right? So, it's not always the case that both spouses are using the same strategy. Sometimes the two paths diverge based off of debt to income ratios. Yeah. So, okay. Yeah. That's what the person meant.
I'd also add to that in that there's also a situation where you can use two different means of certifying your income, right? If we do the community property split, one spouse who got the benefit, the higher earning spouse who shifted income to the lower earning spouse, you can use your taxes to certify. The lower earning spouse who now looks on taxes like they make more money can just use a pay stub, do what's called a manual certification of income. And then you've effectively made that difference in income, it's not counted in terms of student loans. I don't want to say we made it disappear.
I'm gonna post real quick the link for the nachos discount again for the consult. It does look like we have like 3 days of April
54 consults left. You have only 54 left, and there's just 6,000 dental students. So do not miss out. If you're watching it live, you are lucky. If you're watching on recording, act now. You can go into the chat here, or also if people, I'm just gonna let you guys know for the recording, if you text the word debt to 215-543-6454, you will get that link. And I also want to share, Travis, you guys are nice. You do these on Sunday too?
Yeah, I'll tell you why, right? So April 30th, a big rule is about to change. And we think this rule might last for like the first 2 weeks of May. But what the rule is let's say that you took out one loan from undergrad and you kind of took some years off before you went to dental school, right? So maybe you backpacked to Europe, maybe you had a job in between undergrad and dental school, right? So it's normally the case that, you don't get credit in the whole thing based off of what that one little loan was from before dental school. But until April 30th, you can take that one tiny loan that maybe you have a bunch of extra credit on payments on it, and you can throw it in with your dental school loans and get the whole thing treated as if you'd been in repayment.
Throw the loan into your debt backpack if you went backpacking.
Yes. Yes. So, I'll tell you, we've seen some situations with career changers, for example, the people that had 5-10 year gaps between undergrad and dental school, and were able to take that old loan and throw it in with the dental school loans. And now instead of being 20 years still for forgiveness, we could get them 5 or 10 extra years towards that clock, and they might only be 10 years away from forgiveness. So that's a big deal. That could save people 6 figures. And that opportunity is ending April 30th. At midnight.
So we're going to say that for this, because people are going to watch this. Usually everything I do goes viral. I don't know what that means, but it just does anyway. So people will be listening who aren't here now. So if you're listening, make sure to text DEBT, D-E-B-T, to 215-543-6454, because you need to do this consult before April 30th. And you said maybe the first 2 weeks of May, but ideally before May.
Yeah. Yeah. And somebody asked about other deals that we've got. I'll just answer a couple final questions. So, we'll send out this recording to the folks who registered for it. We'll share the recording with Dr. Paul so you can watch it on the Nachos Facebook group or the other spots where they host stuff. In terms of some of the final questions we're getting, somebody said, can you talk about, delaying filing taxes after graduating from residency, right? So, a lot of people don't understand extensions, what an extension is. What is it, Connor? Form at 4868. Did we memorize that one?
Oh yeah.
8878, right?
I'll know
So
that number for the rest of my life.
yeah. So essentially you get one of two things from your tax professional if you use one, right? You either get a Form 8879, which is like, hey, give me permission to file your return, or you get something that says Form 8878, which says, give me permission to file an extension. And so an extension is as long as you file that extension request, and as long as you pay your balance due by April 15th, you actually have until October 15th to file your taxes finally. And then the reason why that matters is, let's say that the majority of dental students and residents and recent grads have a summertime recertification date for their IDR plans, which most people will. So you can intentionally put off the filing of your taxes until the fall. And then essentially, what's the most recent tax return? It's going to show a most recent tax return that's probably 2 years old. Now, we need to run hundreds of these, tests, and we've run quite a few. But, this is like why we stay at the sort of, I would call it the bleeding edge of student loan strategy, because we're always kind of thinking, what are the legal ways that we can save our people as much money as possible? And this is using the existing rules that totally allow you to file an extension for any reason or no reason at all. And we're essentially delaying that final return and saying, hey, IRS, sure, go pull their most recent tax return. And then they're going to go and look, and they're going to see that tax return, might be when you were a fourth year dental student, that's from 2022 instead of 2023 if you filed an extension for this year's tax return, right? So that's what also people are mostly having to recertify for the first time since COVID, sometime in mid 2025. So that's a strategy that you could use by filing an extension for your 2024 tax returns. You could use that more recent tax return from 2023, or the older tax return, I mean. And that means most people have a very rapidly increasing income in the first 3 years, because you have dental student income. You work for half the year when you graduate, or probably more like a third of the year when you graduate, and your taxable income might be 40K for that first year because of just, starting in August and to December, right? And then your first full year of income would be, essentially when you're, you have a full calendar year of income, and the year following the year you graduated. And so this whole extension strategy, I mean, especially for high income people, it could save you maybe even $20,000 or something like that. It's a big deal. So I just, again, want to point out that Dental Nachos link in the chat. If anybody's watching kind of like online or something like that, I guess I could probably pull up the QR code as well, but it's probably best, I guess, just to leave it in the chat.
They also can text the word debt, DEBT, to 215-543-6454. We'll automatically give them back the dental, our co-branded link. So you can save $100 by knowing me. Send me a Chipotle gift card for $25. Keep the $75 for yourself. That's not required, but it's encouraged, Connor.